Congratulations for completing the first chapter. So, today we will be talking about the budget constraint. Obviously, this is part of chapter two's material. And the focus for chapter 2 is towards one particular individual's demand for goods. We will also be understanding how this individual chooses his or her demand for the quantity of goods. And just to recap, we will only be analyzing a choice between two goods X and Y. So, an individual has got unlimited wants. That is something that we have established the previous chapter. So, the demand for goods. And goods can be any form of product or service. You've got food like drumsticks and ice cream, services like haircuts and massages, right? So, in order to achieve these wants, this individual needs resources. And when we talk about consumers, typically the resources would be money for them to buy the goods. A consumer's preference is represented by what we call the utility curve, and the money is basically a budget which constrains them from achieving more utility from the consumption of goods. So as you can see here, the budget constraint actually constrains the utility curve. So today we'll be going through the budget constraint and we'll be trying to understand it into greater detail. So what is the budget constraint? You are going to find this very familiar, especially from the last chapter. So the budget constraint is actually a graph that represents the various combinations of X and Y's an individual can purchase. And of course, this combination is restricted given an amount of income that the consumer has, or what we call budget. So the key point is given an income or a budget. Now, this is the reason why you might find this familiar. If you recall in the previous chapter, we understood the PPF. We are still talking about two types of goods, so it's X and Y. The difference is that now the resources, instead of labor or capital, is now income. And typically, income comes in the form of money, right? But we've got income in kind as well. So what is income in kind? It refers to the initial endowment that a consumer has from the very beginning. An endowment of X and Y. So it's basically you are born with this amount of X and Y. We'll talk about this later in the chapter. We now begin learning about the budget constraint using a very simple mathematical approach. So it's just one simple equation. There is no need to panic about complicating math. To mathematically illustrate the budget constraint, we have an equation that looks like price of X multiplied by X plus price of Y multiplied by Y, which is less than or equal to income. So, we know that Px and Py is simply the price of X and Y, obviously, which is in monetary form, and I is your income, which is also in monetary form. We simply call it nominal income. X and Y is simply the quantity demanded for these two goods. Something else pretty obvious is that the price of X multiplied by the quantity of X represents the total expenditure on good X, whereas the price of Y multiplied by Y shows the expenditure on good Y. So if you add up expenditures on both good X and good Y, you get the total expenditure of this particular consumer. And obviously, this amount has to be less than the income this person makes. So in economics, we assume that all individuals are rational. So they are going to maximize their utility by basically spending all their money. So there's going to be no utility derived from future consumption. So with this few assumptions in place, we can safely say that the individual will spend all of his or her income. So therefore, you get the budget constraint that looks like this. So instead of a less than or equal to sign, I just changed it to an equal sign. So let me give you an example of how the budget constraint might work in real life. Now I'm just going to take out my wallet and I realize that I have got $50 in my pocket. So I'm just going to take it that my income is $50. The price of good X is $10 and the price of good Y is $5. Okay, I want you to imagine that I'm a consumer that only likes good X. So I'm only going to buy good X and 0 Y. So the total amount of X I can buy would be simply $50 divided by 10, which is 5. So I got 5X and 0 Ys. But if I'm only going to buy Y, alright, I'm going to have 0X and I'm going to have a total of 10Y. So you see, when I spend all my money, this is the amount of stuff I can get. But obviously, I want to have some X and some Y. And I'm going to show you how this can happen using a graph. Before I show you the graphical approach, there are two things you need to understand. First, real income. Second, the price ratio. The concept of real income is a very important one, but yet it's also very easy. It is basically my purchasing power in terms of goods. And to find that out, I just have to take my nominal income in terms of money divided by the price of X or divided by the price of Y, and I have my purchasing power in terms of goods. It is extremely important to understand the concept of real income because this concept will be used in the further chapters and even in macroeconomics. So basically, real income is important because individuals tend to make the decisions based on the real income rather than the nominal income, because we are always concerned about the amount of goods that we can buy instead of how much money we have, because prices change all the time. And as the name implies, the price ratio is basically the price of X divided by the price of Y. So constructing of the graph to show the budget constraint is pretty simple. You have an X and Y axes to represent both of the goods. The next step is to mark out on both axes what is the total number of goods that you can buy with that particular income. So it's basically your nominal income divided by the price of each good. Therefore, you have got the two ends. So you connect the both lines together, and what you have is the budget constraint. See, I told you that it's simple, right? So you have the real income in terms of both X and Y. The next thing you need to do is to mark out your price ratio, which is over there. You will understand the importance of the price ratio in the next half of the video. So this price ratio is actually just the gradient of the budget constraint if you think about it. We know that to calculate the gradient, you just take the change in Y divided by the change in X. So I just have to divide both of the real income together, and what you'll see is that I actually get Px over Py. So the gradient of the slope is literally the price ratio. At this point, you have successfully understood the basics of constructing the budget constraint. So you need to know these three figures very well. The real income in terms of both X and Y, as well as the price ratio. You're going to need this for graph dynamics, which is coming up in the second half of the video. Another basic point which I have to share with you is simply the notations part. So notations are algebra expressions for things like your income, prices, and quantities of goods. And we need to understand how this works for graph dynamics. Graph dynamics occur when values change, so like changes in income, prices, etc. So I'm going to show you how we notate the initial values for your income and your prices. What you notice is that we are going to add subscripts to these algebra expressions. So you got I naught, Px naught, Py naught, and so on and so forth. So assume that these values change, maybe they increase or they decrease. So we're going to increase the value of the subscript, so you actually get I1, Px1, Py1, X1, Y2, so on and so forth. As long as the values keep changing, just increase the value of the subscript. And obviously, if some of the values do not change, or what we call remain constant, just leave the subscript as naught. Well, we don't call it 0, we actually call it naught. So this part of the video has really built good foundations for chapter 2. Okay, let's understand the dynamics of the budget constraint and how exactly this graph works. So we're analyzing the budget of one particular consumer, and we understood that to understand the budget constraint, we need to look at the real income as well as the price ratio. So just a quick recap, real income can be either in terms of X or in terms of Y. The price ratio is Px over Py. The real income helps you identify whether the vertical and the horizontal intersect changes. And the price ratio is extremely useful to help you to determine whether the slope of the budget constraint has changed after some dynamics. So an increase in this value means that the budget constraint is steeper, and a decrease in this value shows that it is flatter. The first type of budget constraint dynamics will be a change in nominal income. Let's just say that nominal income has increased, and obviously for the consumer, this is a good thing, right? So the next step is to identify how does the budget constraint move. So as discussed, the first step will be to take a look at what is the real income in terms of both X and Y, because this determines whether the intercept changes or not. What we can establish is that both real income will increase due to a larger numerator. The question is the percentage increase in both real income the same? We look at X first. So if nominal income was 50 and the price of X was 10, this gives me 5X. And if income were to increase to 100 divided by 10, I would have 10x. So this is in terms of x, right? So let's look at y. Same thing, income is still 50, all right? And the price of y would be, say, 5. That would give me 10y. So increasing the income to 100 will give me 20y, right? So as you can see, the percentage increase in both real income of x and y is the same. What we see here is that the real income for both x and y has increased by 100%, or it has doubled, right? So what this means for the vertical and horizontal intercept is very simple. What you should expect to see is a shift of the same amount for both the x and y intercept, right? What this means is that it is a parallel outward shift of the budget constraint. So to confirm this, let's just take a look at the price ratio, which again tells us about the slope of the budget constraint, and we know that there is no change because the prices of both x and y has not changed. Therefore, we confirm that this is a parallel shift of the budget constraint. So let me just show you graphically what this should look like. So just let me quickly draw the initial scenario of the budget constraint. Take note of the notations that I'm using. Initially, we've got values of I0, Px0, Py0. So when the budget constraint shifts in a parallel manner outwards, what you see is that the notations will change. Instead of I0, I'm using I1 now. So this is the result of increasing your nominal income. So we know that instead of going up, nominal income can go down as well. And obviously, this is going to make the consumer a little bit unhappy about this situation, right? So therefore, there's a sad face there. So very quickly, let's take a look at real income first. So what will happen to the real income in terms of x and y? We know that it's going to decrease because of a smaller numerator, right? And we already established that it will be decreasing by the same percentage. Therefore, what you get is a parallel inward shift. And this is confirmed by the price ratio, which remains constant. Therefore, it is a parallel shift. So what would this look like in the graph? It will be the same. You know, instead of shifting outwards, we're going to be shifting inwards, right? Because real income for both x and y has decreased. And take note of my notations. I'm now using I2, which shows that, you know, there's been a new dynamic in the nominal income. So we now move on to the next type of budget constraint dynamics, which is obviously changes in price. And let's just talk about the price of good X. So price can increase. And what do you think this would mean to the consumer? Is it a good thing or is it a bad thing? Well, obviously it's a bad thing. I mean, something that's more expensive, you know, wouldn't be very nice. So we're going to start with the same first step again. We are going to look at what happens to the real income in terms of X and Y. So we know that real income in terms of X is going to change, and in terms of Y is going to remain the same, right? So what this means is that the Y-intercept is not going to change, okay? So a clue is that the budget constraint is going to pivot around the Y-intercept. So let's take a look at the real income in terms of X. Well, we're going to have a larger denominator because the price of X increased. So what happens is that a number divided by a bigger number gives you a smaller number. Therefore, a decrease in real incomes in terms of X. Let's look at the numerical example right here. With the same nominal income of 50, an increase in the price of X from 10 to 20 actually gives us a smaller real income. That is the effect of having a larger denominator. So what does this mean for the x-intercept? It means that it's going to shift inwards. And so if the x-intercept is going to shift inwards with the y-intercept not changing, there is a rotation. So now let's take a look at the price ratio to confirm this. Again, let me use a numerical example. So the price of X has risen from 10 to 20, and let's just assume that the price of Y is 5. As you can see, there's an increase in the price ratio from 2 to 4. So what this means is that the budget constraint is now a steeper one due to the increase in the price of X. So taking note of those 2 points, let's see what happens to the budget constraint. Very quickly, let me draw my initial scenario first. So I know that I'm going to have a smaller real income of X, so therefore the X-intercept is going to shift inwards, and I'm going to have a steeper budget constraint. Therefore, this is what I get. Take note of the notations. I've changed px0 into px1 to illustrate an increase in the price of x. Naturally, what we will be talking about next is a decrease in the price of X. And obviously this is going to be a good thing for the consumer because, with a lower price, you will obviously be able to buy more of X, right? So let's take a look at the same things again. We'll look at the real income in terms of X and Y. What we see here is that the denominator is going to decrease, which gives us a larger overall number. And obviously the real income in terms of Y is just going to remain the same. So what this means is that the x-intercept is going to shift this time outwards, not in but out, alright? And let's just look at what happens to the slope. We know that this is going to have a smaller numerator, therefore the overall figure actually falls. What you get is a flatter budget constraint. So taking note of these 2 points again, let's go back to the graph and see how this works out. This is going to work opposite from what we experienced just now. So the x-intercept is going to shift out, and you're going to have a flatter budget constraint. So take note of the notations here. So the next thing that we can talk about is the introduction of a lump sum tax or a lump sum subsidy. So let's explore the lump sum subsidy first, and obviously this is going to be a good thing for the consumer because a lump sum subsidy is basically any government authority giving you a sum of money to spend. My standard procedure will be to, of course, look at the real income first. Using capital letter S to represent the lump sum subsidy, we add S to the numerator of both real income in terms of X and Y. And we notice that both the real income is going to increase again by the same percentage. So what you see is that the budget constraint is going to shift out in a parallel fashion, similar to an increase in nominal income. And if you're going to follow the same drill by looking at the price ratio, you will notice that it has not changed. Therefore, this confirms the fact that it will be a parallel outward shift. So let's take a look at the graph and how this can actually come in play. It's actually very similar to an increase in nominal income. What you have to take note here is what are the notations that I'm going to use, which you have already seen in the mind map as shown. Just look at how fast I can actually draw graphs and label my diagrams. So what happens is that the budget constraint is going to shift out as seen here, and the notations are as such. You need to add the capital S to your numerator, and the price ratio is going to be the same. So that is for the case of a lump sum subsidy. So now we move on to a lump sum tax, which is represented by capital T. Well, basically everything is the same as a decrease in nominal income. Looking at the real income again, we see that we have to deduct capital letter T from the numerator of both real incomes in terms of X and Y. So what you see is a decrease in real income with the same percentage for both X and Y. What you'll get is a parallel shift of the budget constraint inwards, and this is again confirmed by the price ratio being the same. So looking at the graph, you will notice that this is fairly easy. You just have to shift the budget constraint inwards and take note of the notations. Remember to deduct T from the numerator of your X and Y intercepts. And what we're going to talk about next is very similar to changes in price. We will be talking about per unit subsidies as well as tax, and our focus will be again on good X. So imagine a government authority giving you a sum of money for every unit that you consume. So if you're going to buy maybe 3 units of good X, they will give you 3 times of the subsidy that they were meant to give. So of course the subsidy will be good for a consumer because it's going to help reduce the price, which therefore translates to a higher real income. So if you're going to apply that concept to these 2 figures over here, what you'll notice is that I'm going to minus small letter s to the denominator so that the overall figure is going to increase. The real income in terms of y is going to be the same because there's no subsidy for y. Therefore, what you have is a shifting out of the x-intercept. Let's now take a look at the price ratio. I have to deduct s from the numerator because now it costs lesser for me to purchase x. So what I see is a smaller figure. Therefore, the budget constraint is going to be flatter. let's take a look at how this is going to look like in the graph. And again, this is going to be very similar to the scenario where prices change. So what you expect to see is the rotation of a budget constraint pivoted on the y-intercept. So I know that the real income in terms of x is going to shift out, so my x-intercept is going to be further to the right. Therefore, I'm going to get a flatter budget constraint, and just take note of the notations over here. Alright, for both the real income as well as the price ratio. Now, let's talk about the more adverse scenario whereby there is a per unit tax on each unit consumed by the consumer. So we represent the per unit tax as a small letter t. We now apply the same drill to the real income in terms of x and y. So I'm gonna just write out these figures over here, and what you'll notice is I have to add a small letter t to the denominator of the real income in terms of x. And again, the real income in terms of y is going to be the same, therefore you have a shifting in of the x-intercept to represent a fall in real incomes in terms of x. Now let's take a look at the price ratio. We have to add t to the numerator to represent the tax. So what you'll see is actually a steeper budget constraint, which confirms my shifting in of the x-intercept. Take a look at the diagram here. You will see that whatever we just discussed is coming true. Take note of the notations. I'm actually adding small letter t to px naught. Alright, so now let's move on to something else a little bit more different, what we call a transfer in. So just let me briefly explain what this means. What this means is that a government authority is going to give you X bar for free. Alright, so the consumer gets X bar, which can be any amount that is set, and basically what the consumer does is that it consumes this free amount of X before buying additional units of X if the consumption is not enough. So again, let's take a look at the real income in terms of X and Y. So what's going to happen is that I'm just going to add X bar to the entire real income of X. And of course there will be nothing for Y. So what you see is that the real income in terms of X will increase by X bar. So what about the price ratio? Does it change? No, because it's just not stated anywhere, right? So I can now confirm two things. The first thing is that the x-intercept is going to shift out for sure, 100%. And it will be a parallel shift because the price ratio is the same. So what's the difference here? I'm just going to recap on this point. The consumption of X from 0 to X bar will be free. And what will happen is that I'm going to get a horizontal budget constraint from 0 to X bar. Let me explain why this is the case. If you take a look at the price ratio, you'll notice that it is actually 0 over Py because the price of X is 0 for that amount. Therefore, what you see is that this is a horizontal line. I mean, basic maths just explains it. A line with a gradient of 0 is basically just a horizontal line. So let's take a look at how this would look like on the graph. So let's just imagine X bar occurs somewhere here. What I'm going to do next is to draw a vertical line upwards, and I know that my y-intercept does not change. So from 0 to X bar is going to be a flat line, so I have got this as a budget constraint. So what happens to the rest of the budget constraint then? It is basically the parallel shift that we mentioned. So take a look at this. The most important thing for you to take note of is that the x-intercept here, you have to add X bar to it. So this is how a transfer affects the budget constraint. So I'm just going to throw in one more example. What if there is a buy one, get one free deal? And again, my emphasis will be on good X instead of good Y. So, like before, we are going to focus on the real income first. So this is very straightforward. For X, given the same amount of nominal income and the price of X, you can get 2 times more because of the buy one get one free deal. So the real income in terms of X is going to increase by 2 times. Therefore, your x-intercept is going to shift out. This is very similar to a reduction in the price of X. What happens to the price ratio? Well, the price of X is actually reduced by half because you're buying one and getting one more free. So the entire figure drops, and what you see is a flatter budget constraint. So let's take a look at the graph. Similar to a fall in the price of X, what you should see is a flatter budget constraint as shown in the graph over here. So just take note of, again, the notations for the x-intercept as well as the price ratio. Just let me congratulate you because you've actually learned most of the dynamics that can happen to the budget constraint. Well, of course, we want to take things to a higher level, so I'm going to introduce you to the concept whereby your budget constraint can be kinked. And what I mean by kinked is that it won't be just one straight line. You have already seen this in the transfer in budget constraint dynamic. So the purpose of me teach you this kinked budget constraint is to understand real income better, and also to help prepare you for possible exam scenarios that might be a little bit more challenging. So the first out of three scenarios that we can think of is that after consuming a certain amount of X, maybe say X cap, the price of X actually falls. So this can actually occur in maybe most retail businesses, like they want to encourage the consumption of more of their good. So let's take a look at how this is going to affect the budget constraint. So what I like to do first as a step to guide me is to mark out where X cap might be and then draw a vertical line upwards, and I know that from X cap onwards my price of X is going to be lower, therefore I'm going to have a flatter budget constraint. But the question is, what is the X intercept? What is the real income in terms of X? So just recap the definition of real income. It is the amount of goods that you can purchase, right? So this is going to consist of two parts. The first part is the amount of X that you consume before the price of X actually changes. And of course, this amount is simply just X cap. And the next component that makes up your real income in terms of X is how much more X can you actually purchase with your remaining income after purchasing X cap. Well, that makes sense, right? You gotta spend everything. We assume that they're not gonna save. So I need you to think for a minute, what could be my remaining nominal income? How do I express this in algebra? So I take nominal income and I deduct away how much I spend on X cap, which is basically Px0 multiplied by X cap. I take this entire figure and I divide it by Px1 so that I convert this entire amount into real terms. So now let's move on to the second of three possible scenarios, which is simply a transfer of X bar to the consumer. Then after X bar, further consumption would require a per unit tax, which is represented by a small letter t for every additional unit of X consumed. This may be a tactic used by the government to ration the consumption of good X. So it is actually pretty obvious to me that there is going to be a kink in the new budget constraint. So what I do is I mark out where X bar is first. So I draw a vertical line and I know that a transfer would actually look like this, as discussed in the previous section just now. So how does the rest of the budget constraint look like? It would look like this. Well, the reason why it is a little bit steeper is very simple. Well, just let me write the ratio in a better way. Okay, so it's Px0 plus T over Py0. So obviously, the budget constraint is now steeper because of a larger numerator, which makes the overall price ratio larger. Therefore, what you get is a steeper budget constraint after the consumption of X bar. The challenge now is to identify what is the real income in terms of X. So if we're going to apply the lesson that we learned from the previous scenario, we know that we have to break down real income in two. The first part will be definitely X bar, and if you look at the second part, you realize that you didn't spend any amount of your nominal income. So therefore, the second part of real income is simply I0 over Px0 plus T, as you can see in the diagram over here. So that's how you identify the real income for this particular scenario. So now we're going to move on to the last scenario for the day. Just let me shift this down. Okay, so we're going to face a unit subsidy until the consumption of, say, X cap. And then after X cap, you're going to see a per unit tax on the consumption of X cap. So one reason for this might be because the government is trying to restrict the consumption of good X beyond a certain amount, in this case, X cap. Again, a very useful thing to do would be to identify where X cap can be and then draw a vertical line on top of it, as seen here. Since a subsidy reduces the price ratio, the budget constraint before X cap becomes flatter. As seen here, the price ratio becomes Px0 minus S over Py0. After this, the budget constraint becomes steeper than the original one because of the introduction of a per unit tax. So this is the price ratio that you should see. The following mathematical expressions will actually explain to you in further detail on why the first half is flatter and the next half is steeper than the original budget constraint. The question again is, what the hell is the real income? We know that in a Kinked budget constraint, real income is going to make up of two portions. The first part, as we discussed, is just simply x cap. The second portion is, this is how we're going to do it. You know that you've already spent on x at a price of px naught minus s up to the amount of x cap. So we need to know what is the remaining nominal income after spending on x cap. Again, we deduct from the nominal income the amount spent on x cap at the price of px naught minus s. You can see the mathematical equation over there. We're going to divide this entire portion by the new price of x, which is px naught plus t. So therefore, what do you get in the real income in terms of x is simply this expression over here. See, it's actually pretty simple, right? If you break things down into simple bite-sized portions. That actually brings me to the end of this video. You have learned a great deal about the budget constraint, and this should propel you in your study for chapter 2. I would like to thank you for studying with Quickienomics, and I also want to thank you for your continuous support.